Hey everybody, it's your boy Sean McLaughlin at Options Sean on Twitter X. Today is Wednesday. What is it? September 24? Yeah, September 24, 2025. Hope you're doing well. This is What Are My Options? This is a completely unscripted show where I'm going to riff on some concepts that people have been asking me about. I will take questions in the chat. If you have questions for me, please throw them into the chat. If you want to talk about some setups that you got your eye on, some trades you're thinking about making, you want my perspective from an options trader perspective, throw it in the chat. We'll talk about it. Okay, that's what we're here to do. That's what we're here to do. I do have some questions just off the top. Right off the top, we had a question come in email earlier this week from a viewer named, well, it doesn't matter what his name is. We'll respect his privacy or her privacy. But the question was generally related around how do I take profits? How do I, when do I decide to take profits? Is there an algorithm that I follow? Is there a process that I follow? Do I always sell half of my position at a double? Things like that. Like what goes into my mind when when I'm exiting a position? Well, let's talk about losses first. Okay. When I'm in an options position, most of the time, not every time, and when most of the time I put on a defined risk trade, meaning I know the most I could lose no matter what. In the situation where I do an undefined risk trade, that has some different rules. Okay. I will usually have a stop loss level, a chart based level that if the underlying breaks that level, then I'll exit the position. Sometimes I may have a P&L loss, meaning, if it's a credit spread and I sold it for $3 and now it's going to cost me 450 to close it, maybe that's where I pull the plug and take the loss, right? Those are different rules, but with defined risk trades, first of all, there's never a panic to exit. Okay. If you're doing it the way I do it, you're setting your maximum risk right up front and you're accepting that risk as a very real possibility that you may lose all of your money, right? So let's keep it simple. Let's say I bought a call and let's say the call cost me $3, right? I bought one contract that cost me $3, so that's $300 of risk. Okay. I am comfortable losing $300. I don't want to lose more than $300 and I won't because that's the most I can lose in that trade. But a $300 loss, at least for me and for my account, is an acceptable loss. Okay. That number might be different for you. Maybe 100 is your max. Maybe 1,000 is your max. Whatever your number is, you want to stick to it. I generally like to size my positions in a way that I won't lose more than 1 to maybe 2% at most of the value of my account, right? So if I have a $100,000 account, I don't want to lose more than $2,000 on any one position. Now that's pretty rare. I tend to stay at 1% or lower. That's just me because I like to have a lot of trades on, right? I like to have a portfolio of diverse positions. Yes, they might all be bullish in a market like this. Most of them are, right? But the more variety I have, the more diversification I have, the better I potentially can withstand some volatility storms in the market. Okay, it doesn't always work, right? Sometimes when markets crash, everything goes to a correlation of one, right? I do some hedging to help with that. It's never perfect, um, but look, I want to risk small amounts of money. Okay. I don't want to have all of my account in one trade. Now I know there's some super traders out there that love to plow all of their buying power into their best ideas or most of their buying power into their best ideas. And good for them. If you can do that, that's great. I don't recommend that with options trading for the simple fact that we always have a risk of losing everything, right? Especially on a debit spread. Any debit we pay, we can lose 100% of that debit. So I wouldn't want to put all my account in any one trade. That's a bad idea. All right. So losses kind of take care of themselves. We don't need to worry about it. But really the bigger question that this reader or this viewer was asking was, when do I take profits? How do I decide where I'm going to take profits? So, Gene, let's pull up my chart here real quick, and I'm cherry picking a stock that I'm currently in right now, CM. Okay, this is a trade that's been working really well for us. I'm long the January 75 calls. We've been in this thing since May. We got in right here, May 23rd. Paid $1.50 for these calls. The calls are now, oh, about $6 in the money. So they're worth at least $6 more plus some premium. I haven't looked at the price, but they're probably about $7 right now. Okay. Uh, why haven't I taken profit in this? Okay. Well, there's no perfect answer for me on when to take profits. I used to be a firm believer whenever I buy simple calls like this, where I buy the 75 calls. I used to be a firm believer that I will automatically sell half of my position when I've doubled my money, right? So I bought them for a buck 50. I will automatically sell half at $3. That pays me back my original risk, right? The original money that I risked, I get paid that money back. And then I have a half position with essentially no risk, right? Yes, I have open profits and that's real money. That's my money, right? I want to think of it as my money. But if I lose all that, that's fine. At least I didn't lose money net at the end of the day. Okay. I used to think that way. And in certain circumstances, that is a viable strategy. I know Steve does that with the breakout multiplier, and that works great for him. And that's awesome. I'm not shitting on it. I think it's a great strategy. I don't do that so much anymore, mostly because I've done a lot of deep dives into my past trades and I've run the numbers. And while holding my full positions instead of taking risk off the table at a double, while that increases my portfolio or my position volatility, in the end, I make more money. I've had some trades that go on to be huge winners. And if I had cut those short because I sold half at a double, then I don't, I miss out on those big gains. And at the end of the year or at the end of whatever reporting period you look at, whether it's a month or a quarter or every year, when you look at back at the numbers and you look at your winning trades, you'll find that the vast majority of your profits come from just a handful of the trades you've done. All right. And for me, I need to have a couple really big winners to make up for all the small losers that I get. All right. So I would like to invite you when you are trading, especially with a position, an options position that has open-ended upside, like a long call. I would invite you to create ways or mindsets that allow you to hold these positions longer, especially when we're in a bull market like we've been in, right? When you're in a bull market like we're in, it pays to hold on to these things. It pays to hold on. And so you'll notice in my chart here in this CM, I got 85 highlighted up here. Now you might be wondering, what's that? Okay, that is a profit target level for me. I chose 85 in this case because that was a Fibonacci extension when my researchers put this idea out about CM. They had identified 85 as a logical level where CM might run into some upper resistance. Okay, so for me, I'm targeting 85. If we get there, that's where I will sell half of my position. I don't want to sell the whole thing. I want to leave myself available for further upside. We still have what, 4 months to expiration on this. I still want to give myself more time to ride this trend, which is a very powerful trend. This trend started off the April 7 lows. Stock was at 55 bucks. It's now at 81, and this stock is showing no sign of slowing down. All right, so 85 is a level that we've identified. The research team has identified as that's a logical level where we may run into some resistance. So I'll take some profits there. My options, if I get there at 85, they'll be worth at least 10 bucks a contract. That's what? That's 6 times what I paid, right? It's not a double. It's more than that. It's 6 times what I paid, right? So I'll sell half there, lock in some gains. Now I have guaranteed gains. I can't lose money. I'm making money no matter what, but I still have half of the position to ride it even further. So when it comes to taking profits, I am more of the mindset with open-ended upside positions like a long call or a risk reversal, something like that. I want to let these things ride as much as I can. I may have a level where I'll take some profits, but it's not an arbitrary sell half at a double. Okay. It's not what I'm doing. Again, I have no problem with that. If that's something that makes you comfortable, please continue doing that. But for me, I'm in the business of trying to get lucky. I'm in the business of trying to catch some rocket ships. I want to make some big wins because just a handful of big wins can make my year. Okay. I mean, here's another example of one of those, right? This WBD, I got extremely lucky. I'll be the first to tell you that I got extremely lucky in this trade. Okay. I uh bought calls here. I bought what did I buy? I bought the October. Let's see, the stock was trading around 12. I bought the October 13 calls on this day on September 11th, literally 13 minutes before the news hit the tape that sent this stock ripping. This stock is now a takeover target. The stock's in play, as the cool kids like to say. I had no idea. I had no idea. All I saw was that this stock was starting to break out of this wedge, riding above its 50 period moving average. So on this day here, right around when the stock was trading just shy of 13 bucks, I bought a whole bunch of October 13 calls. And literally 12 minutes later, news hit the tape, the thing went ripping. Now, had I sold half of my position at a double, I mean, great. I'd be free riding the rest. But right now, as this position stands right now, because I still have the whole position on, this is my biggest winner of the year. Now, I'm knocking on wood right now because I may have just jinxed it, right? This thing has plenty of time to roll over on me. This might end up giving back a lot of profits. Maybe it turns into a loser. Who knows? My strategy on this trade is I'm going to hold these October options into expiration if I can, right? I think there's more upside here. The chart certainly suggests that there's more upside here. But had I sold half at a double, sure, I'd have a nice win on my hands, right? I'd have nice profits. But right now, this trade is my biggest winner of the year. And I got totally lucky. Totally lucky. So, when it comes to long calls, I'm trying to let these things run as high as possible. If I have an upside target, it's generally because it's a stock that I bought maybe on a dip, and I think it's going to retrace and make a run back to all-time highs. If there's a good distance to get to those all-time highs, maybe at all-time highs, that might be a level where I'll take some off, maybe take my half of my position there, right? The calls will not have doubled. They hopefully will have tripled or quadrupled by then, right? But I'm taking that half off at that level because that's a logical level, not because of an arbitrary, artificial, I want to sell half at a double, right? It doesn't work for me anymore. All right. Now, if we're talking about positions like a bull call spread, for example, let me flip to my other chart here. Let's talk about, I got to do this. So I got to do this little trick. I don't know why that always does that. But let's say I'm in, I don't know. Let's just pick up a stock. Let's say Microsoft. Okay. Let's do a hypothetical trade here. Let's say I'm going to put on a bull call spread. We'll do January or December options. I'm just going to randomly pick strikes here. Let's do the 510, 520 bull call spread. Okay. So let's analyze this. Let's look at this trade. So here's what a bull call spread looks like. Well, let's get this out of here. We don't want that. This is what a bull call spread looks like. You're long the 510 calls, you're short the 520 calls. Okay. And as you can see, your downside is capped, right? Along the x-axis here are the prices of the underlying stock. Along the y-axis is the P&L. We just did a one lot, right? So this is the P&L of what you would earn across a range of prices. And the blue line here is the range of prices at expiration. So if you held this thing to December expiration, on expiration day, if Microsoft was trading at 490, for example, we'd be taking the full loss, 498. That's what we're paying for right now, right? We're paying 498 for that spread. We would lose everything. Okay. Meanwhile, if the stock ripped higher and it was at 550, let's say, on December expiration, I would make $502. Why 502? Because the most the spread could be worth is the distance between the strikes. The 510 that I'm long, the 520 that I'm short, the distance there is 10 bucks. So the most that spread could be worth is $10. But you subtract the 498 I'm paying for it, that equals 502 or $502 per one lot. So you can see, no matter how high Microsoft goes, my profit can't be any more than $502. Okay. That's not necessarily a bad thing, right? The trade-off is I'm participating in a bullish Microsoft trade for a cheaper price. Instead of just buying the 510 calls, if I bought the 510 calls, they would cost me, hold on, let's bring up the thing. The 510 calls would cost me $25 and change, right? Versus buying the spread, which costs $5. So 20% of the cost, I'm still participating on the upside. So it's cheaper. I have less money at risk, but my upside is capped. In a trade like this, in a bull call spread where my upside is capped, I will generally take profits when I can sell the spread for 80% or more of the full value of the spread. So in this case, the most that spread could be worth is 10 bucks. If I could sell it for 8, I'll do so. All right. Why would I sell it at 8? Why not 9? Well, nothing wrong with 9. Nothing wrong with 7. I like 8. It's like the 80-20 rule, right? I'll take 80% of the profit or 80% of the full value of the spread and leave the other 20% behind, because in a position, if this spread became worth 8 bucks, right? That means it can only earn another 2, but I'm risking 8 to earn 2. Okay. The stock can completely reverse on me for whatever reason. And that $8 of value that spread has right now, I could lose all of that. It could go to 0. And I was risking all $8 just to make an extra 2. I don't like that math. So the 80-20 rule applies for me. That's when I'll look to exit a defined risk spread like that. Meanwhile, um, and I don't do this always, but I'll set this up ahead of time. I'll make a plan for this on a defined risk spread, even with same thing with long calls. I'll have two potential exits, two potential signals to get me out of the trade. The first and the most obvious one is a chart-based stop loss. So let's bring up the chart of Microsoft. If I already get into this trade right now, and it's a swing trade, right? I have a few months for it till expiration. I might look at this 500 level, kind of right here, where it looks like it caught some support, or maybe 495. I'd be like, if it breaks 495, I'm out. So for whatever the value of that spread is, I'm out. Okay. It won't be much, but I don't want to take 100% loss if I can avoid it, right? Remember, I'm sizing these positions in a way that if I do take 100% loss, it's okay. I can survive that. I'm not risking more than 1% of my account. But if I can avoid losing 100%, I'll do it. And if the stock breaks the 495 level, that would be my signal. Okay, time to get out. That's stop number 1. Stop number 2, I don't do this every time with bull call spreads or vertical spreads, but oftentimes I'll just stop out if the position loses half of its value. All right. So if I paid, what was it, 495, 498, let's just call it $5. If I paid $5 for this spread, if the spread now is only worth 250, maybe the stock's gone sideways. It hasn't done anything. It hasn't broken my stop loss level, but it hasn't really gone up either. It's just kind of treading sideways. Well, calls have value that erode away every day. That's called theta, right? All else being equal, if a stock goes nowhere, the premium in those options is going to slowly decay away. And so it's very likely that if Microsoft went sideways while I had this position on, the spread that I paid almost $5 for it later on could be only worth 250. All right. So if it loses 50% of my value, that is often where I will close a vertical spread. Not always. And I lay all these cases out in my detailed trade plans that I share on All Star Options, which, by the way, guys, if you're not on All Star Options, what are you doing? Come join us. I got the link there in the chat up top. You could subscribe to All Star Options. I put out detailed trade plans for every trade that I put on, including where I may or may not take profits, where I'm going to stop out, how I'm trading it, right, like what option strategy I'm using and why. All those details are in there. It's not only great idea flow for you, but it's educational, right? The whole point is that I want you to learn how to build your own plans and make great things happen in your account. All right. I think I've answered the question there that came in about taking profits. If there's more questions on that, if you need any follow up, put it into the chat, please. Ranger asks, do I ever use trailing stops for positions that are profitable? Absolutely, I do. I don't use a trailing stop. I don't put an actual trailing stop in the market, right? I don't use market orders for stops with options. Why? Because option spreads are too wide. When you want to work and exit in an options trade, whether it's an individual long call or a long put or a spread of some kind, you never want to get out with a market order because you're going to get out on the bid. And let's say it's a call option where the bid is $1.50, offered $1.75. That's a $25 wide spread per one lot. All right. If the stock is bid 150 and offered 175 and you do a market order, you're going to get out at 150. But if you take your time and work a limit order, you can maybe get out at 170, maybe 165, somewhere in the middle, improving your exit. Listen, I know it doesn't sound like a whole lot of money, right? You save a nickel here, you save a dime there. These exits add up. Okay. Don't ever use a market order. Options markets, while liquid and reasonably tight bid-ask spreads. They're not always. And if you're looking at an option that's maybe worth $5, it's not uncommon for it to have a bid of 5 and an offer of 550. All right. If you want to get out quickly, put a limit order in the middle, right? Split that difference. The bid is 50 or the bid is 5, the offer is 550. Get out at 525. Put a limit order in 525. I'll bet you more often than not you'll get filled. Okay? That's $25 extra per contract that you earned instead of hitting the bid. So don't use market orders. And so I'm saying all that because a trailing stop is like a market order, right? If you're trading stock or you're trading futures, trailing stops work to a degree. I mean, if you get triggered during an overnight gap, you're going to get filled at the opening price, which might be lower than your stop, and that's unfortunate. Um, but with options, definitely done. And what I do is I do use trailing stops, but it's just I just update my stops on my chart and I set alerts to let me know when I want to get out. So let's look at some of my all-star options positions here. So like here's let's find one. Let's find one we've been moving stops up a lot in. Not that you can tell, but okay. So here's MRUS, right? This is started out as a call calendar spread. We got into this back in early June. We shorted the July 65 calls and bought the December 65 calls. The July 65 calls expired worthless, which is exactly what I was hoping would happen. And now I'm just left with the December 65s. When I first got into this trade, my stop was right below this breakout level here. I didn't want to see MRUS get below this level, which is right around $50, right? When the stock finally found some support and started rallying higher, we had this big green stick here. I moved my stop to right below this level. So right around 52. Okay. As the stock has consolidated even more, I've raised my stop to 61.50. So this is how I do trailing stops. I work them manually. All right. And every time a stock makes a new high or a new high for me in the position that I'm in, I will look to raise my stops. And so right now I'll probably raise this stop again, maybe up to about 63 coming up. If this green candle follows through, if this thing rips higher out of this base, I'll probably raise my stop to 63. And so I set alerts. And so if the stock breaks through that level, then I work an exit. I patiently work an exit. And for most of my exits, guys, especially my swing trades, I don't exit intraday. I don't, if this thing breaks below 61.50, which is my current stop, if it breaks below 61.50 intraday, that's not my signal to exit. I want to see the stock close below that level. And when it closes below that level, then I'll work an exit the next trading day, right after the open in the first 30 minutes or so of the day. All right. The closing price is the most important price of the day. I don't want to get stopped out on intraday noise on swing trades. Okay. If I was a day trader, of course, if 61.50 was my stop, I'd get out. But I'm a swing trader and I'm holding these positions for weeks and months. Okay. So I'm not worried about intraday noise so much. And of course, remember, I'm able to do that. I'm able to wait till the open of the next day because this is a defined risk trade. I already knew the most I could lose. The most I could lose when I put this trade on was $6. That's the most I can lose. And I sized my position accordingly so that if I lost $6, that's okay. That's okay. So yes, I do use trailing stops, but I don't use them with actual orders in the market. I just observe chart levels and I raise my stops and set alerts, and then I manually work my exits that way. Hope that answers your question, Ranger. Alpha wants to know, how would you choose the two different strikes when doing a bull call spread? And would you choose a calendar spread? When would I choose a calendar spread over bull call spread? So good questions, Alpha. Let me first tell you that there's no magic process for selecting strikes for bull call spreads. Okay, bull's call spread, going back to this Microsoft example, let's bring that Microsoft back up. Yeah, so the Microsoft example here. Oh, of course, I gotta move this off the screen. There we go. So this is a bull call spread. Now, why did I choose 510 and 520? Generally speaking, when I'm buying a bull call spread, I want to buy the slightly out of the money strike. Okay, so Microsoft's trading at 507 right now. I think it was trading at 509 when we first looked at it. 510 was the nearest nearest out of the money strike. So 510. Okay, so I like to buy the 510. Now, as far as selecting a strike further above, like which strike to sell, that's more art than science. Sometimes I'll select a strike based on me thinking that that level is a potential level that will hit into some upside resistance, right? Let's bring up a Microsoft chart here. So for argument's sake, let's say I'm looking to buy Microsoft and I see that 555 is the all-time high, right? Although it looks like 540 might be more real resistance here because this was kind of a gap and just immediately they sold it right away. This 540 to me looks like a real significant level. So I might say, all right, I'm going to buy the 510 calls and sell the 540s. Because if Microsoft is going to run into some upside resistance, it's likely to run into it there. And so if I don't think it's going to go much further than 540, then why not sell that 540 strike, right? Collect the premium that's available at that strike. That's one way I will think about how I select my strikes. The other ones are just a more practical reason, Alpha, is that I'm trying to limit the cost of the spread, right? Let's say let's say I have $1,000 account, or let's say I have $100,000 account, and I only want to risk $1,000 and no more, right? Because that's 1% of my account value. Well, if I'm looking to buy a spread, if I could risk up to $1,000 but no more, I would love to sell the. Let's say I would really love to sell the 540s that we were talking about, but look, it's going to cost me $1,270. That's $1,200 per one lot. That's too much. I don't want to risk that much. I only want to risk 1,000 at most, right? So in that case, I might select a cheaper strike. See, the 135 is too much. Maybe go to 130. So look, if I buy the 510s and sell the 530s, now it's going to cost me 915. So that's under my $1,000 threshold. So sometimes it's just a practical reason, right? I'm trying to manage my risk. I don't want to risk more than X amount of dollars. And so I will sell the strike that allows me to keep the cost of the spread manageable. All right. So those are the two reasons. The better of the two reasons, of course, is to sell the strike at a logical upside target, whether it's potential resistance because that's previous highs and there's previous sellers up there. There's bag holders up at that level. So the stock is likely to at least pause there, perhaps longer than you would like. That's a good level. Or if you have, if you're a chartist like I am, if there's a Fibonacci extension up there that generally comes into play in stocks that are blue skying, that could be a reason too. Those are the preferred reasons for me to select a strike. But of course, I have to be practical. Sometimes I need to limit my risk, especially on these more expensive stocks. And so I will select a target to keep the price of the spread manageable. All right. Joel's asking, what brokerage platform do I use? I use a variety of platforms. The platform you see on my screen right now, this is Thinkorswim, that is now owned by Schwab. I've been a Thinkorswim customer since the beginning of time, basically since they began back in like 2001, I think. I've been a customer of theirs ever since. I have my IRA with them, so I do a lot of trading in this account. I also have an account with Tasty Trade. I do a lot of trading with Tasty Trade. I love their platform as well. What else do I use? I dabbled with Interactive Brokers this summer. I don't have anything good or bad to say about it. I just found I didn't need it, but it was fine. Worked great. Worked great. But I don't know. For me, I think Thinkorswim and Tasty Trade are the two best options for trading platforms out there available to people. They're the cheapest, easiest to use. Tasty Trade in particular is very easy to use. Both are very powerful. Oh, Alpha, I didn't answer the follow-up question you had about a bull call spread. You also asked, when would I do a call calendar over a bull call spread? That's a very good question. So what is a call calendar spread? Let's talk about that real quick and then we'll wrap this up. A call calendar spread is when there's two legs to that trade. There's a short call and there's a long call. They're both at the same strike, but they have different expiration dates. So for example, if I want to do a call calendar spread on Microsoft and I want to do it maybe slightly out of the money, actually let's do it at the 540, right? Because let's bring up the chart. 540 is an area where I think we might run into some upside resistance. Okay. So let's see a little bit more strikes here. So I might want to sell the 540 call and sell the October 540 call and purchase the November 540 call. Okay. And that would cost me $780 because the October 540 call is worth about $1.65 that we're selling. Okay. And the November 540 call, which is right here, costs about $950. All right. So it cost me 950 to buy this. I'll get some money back by selling the October call. The net cost is about 779. So it's cheaper than buying the November call outright. Okay. And I would put a trade like this on because I think that the stock's going to move towards 540, but it might not do it before October expiration when those short calls expire, right? And if the stock can move in that direction, but not quite get there, then great. The short calls are going to expire worthless. I'm going to be left with the long November 540 calls at a discount instead of paying, where was it? Instead of paying 960 for it, I'm getting it for 783 because of the premium I collected on the short call. All right. So I will often use calendar spreads if I think a move is developing, but a move is likely to take its time, and I could have the options market pay me to wait. And let's bring up what this looks like on a P&L graph. Okay, so here's the chart now. The stock's currently trading at 508 right here. Okay, and we did it at the 540 strike. So this is a bullish trade. The purple line shows me what my P&L would be today over the range of prices. The blue line shows me what my P&L would be approximately on the expiration of the short option. So the October expiration date. So as you can see, this is a bullish position. The value of this position is going to increase, but it's going to peak out right around the strike price at 540. What's going to happen here is if the stock blows past 540, then bad things happen. The short call that I'm short and the long call that I'm long, they're basically going to converge in value because if the stock moves really far, if the stock moves to like say 640, right? There's going to be no premium left in those calls. They're going to be trading at their intrinsic values. They're fully in the money. So they're going to be trading at whatever distance they are in the money. They both will. Okay. So to sell those, you're going to get next to nothing, right? Because you got to buy the one call and you got to sell the other call, but they're both basically the same price. So you're going to walk away with nothing, right? So a calendar spread is defined risk, right? The most I could lose is this 784 that I paid, right? But you can see if the stock doesn't move up, stays lower, I could lose everything. If it goes way too far, I could lose everything. So when I have a call calendar spread, if we get to the 540 strike, the strikes that I have the calls at, if we get there before my calls expire, before the October calls expire, the ones that I'm short, I will just take the profit, whatever it is. As you can see, here's where we are right now, right? So this is the zero is the flat line. I have no P&L in the trade because I just put it on, right? But you could see if this stock all of a sudden moved there today, right? I'd be up about 340 bucks. You can see it by my cursor there. I'd be up about 340 bucks. It's an approximation. This is not exact, right? Because other things come into play, like the implied volatility in the options can change. But you could see that I'll be sitting in some kind of profits. I'll take profits if the stock moves to my strike price before the short options expire. Okay. So with a calendar spread, there's two ways to win. You could win because the stock moves to your strikes before the short calls have expired worthless. You take the profit and run. Walk away a winner. Great. Or you can win because the stock moves your way, or at least goes sideways for a little while. The short calls expire worthless, and then you're left with the long calls with theoretically unlimited gain after that. In fact, you kind of see what that looks like here if I add a little thing here. I morphed the chart. See this red line, or this, yeah, I guess that's red. This shows the P&L of the long calls, right? So if we're after October expiration and the short calls have expired and now I'm just left with the long calls, you can see my long calls, unlimited upside as we go further. Now, a word of caution when putting on calendar spreads. I want to put a calendar spread on when implied volatility is relatively low because it's a position that benefits from high implied volatility. If volatility rises, then the long calls that have more time to expiration, they're going to increase in value faster than the short calls, which is going to increase the value of my spread, right? That's a good thing. So if volatility is low, it really can't go any lower. It's only going to go higher. That could be a good thing for my position. If I get the direction right and volatility expands, I'm winning. The flip side, though, is if I bought a calendar spread, say like here in April, see at the bottom of my chart here, see this blue line? This is implied volatility. In April, when we were having the tariff temper tantrum, volatilities across the board were screaming higher. because there was a lot of uncertainty. There was a lot of risk and people were afraid. And when people are afraid, they bid up the price of options. And so if I would have put on a bullish call calendar spread here on on April 8th, okay, you would have seen that I would have eventually gotten the direction right. But my profits probably would have been pretty underwhelming, less than I would have thought. Why? Because implied volatility just completely crashed over the next 4 or 5 weeks. And so I would have been swimming upstream against volatility. That would have been working against my position. Yes, I might have still exited that position with a profit, but the profit probably would have been a lot less than I thought because the long calls in that position, a lot of the value of that call was premium, and that premium got sucked out as the volatility came out of the market. So generally, I want to be a buyer of calendar spreads, whether they're call calendar spread or put calendar spread. I want to be a buyer when volatility is cheap, not because I'm necessarily hoping to benefit from rising volatility, although that's a nice benefit if I get it, but mostly because when volatility is low, it's not going to go much lower. That's it. All right. All right. How do I feel about a contrarian long Lulu play? Let's look at that real quick. How do I feel about it? It's looking pretty good. Gene, you tell me it's time to go? We got a wrap? Is that what you just said? All right. All right, so let's end here, guys. Lulu, how do I feel about it? I mean, I like it here. I mean, if it breaks, I mean, this seems like a good gap fill candidate, maybe up to 205 from there. I don't know. This thing's just been getting beaten up so bad this year, though. I'm not much of a contrarian play guy myself, Joel. But you know, if you put on a defined risk trade, define your risks, take a shot. That's the great thing about options. We could define our risks, so we could take shots. All right. All right, guys, I got to wrap it up. We got another show starting pretty soon. So thanks for tuning in to What Are My Options? We'll do this again next week, next Wednesday at noon Eastern. Catch me tomorrow on the Options Jam session. I believe that's at 3 Eastern. I'll send a note out about that on my newsletter. Sign up for my newsletter, guys. It's in the chat up there, the first link up there. You'll get alerted of all my shows and just all kinds of options related stuff that you might find interesting as an options trader. All right, everybody. Have a great rest of your trading day. I'll talk to you again tomorrow. Until then, trade them well, be well. See you soon. Bye-bye.